Health insurance protects against the expenses of medical care. Hospitals and physicians once provided this care alone. Increasingly, urgent care centers and home health care providers are giving this care, too. Types of health insurance policies. Health insurance protects against risks that affect a person's health and quality of life for the individual or the family. The financial impact of disability and sickness can impose great hardship on a person. Studies show that the average cost of a hospital stay in the United States is over $10,000. Unlike the risk of death, a person faces health risks often during a lifetime. Health insurance provides financial protection against these risks. No single health insurance policy can cover every health risk. Instead, a variety of policies address these risks. Disability income policies replace income when disability keeps the insured from working. Medical expense policies cover the cost of medical care and services. Accidental death and dismemberment, AD&D, policies pay a benefit if the insured dies or is dismembered from an accident. Medicare supplement policies provide private coverage to supplement Medicare coverage. Long-term care policies cover the cost of long-term care in a nursing home, at home, or at extended health care agencies or facilities. Limited benefits, or voluntary benefit, policies cover specific conditions or provide benefits for specific health services, including accident-only insurance, dental insurance, vision care insurance, prescription drug insurance, specified disease insurance, supplemental health insurance, travel accident insurance, credit disability insurance. Providers of health insurance. Health insurance is available through private companies and organizations and through the state and federal governments. Private insurance providers. In the private sector, two types of insurers offer insurance plans to individuals and groups. Commercial insurance companies. Health and managed care service providers. An indemnity policy pays the expenses of a loss. Commercial insurers write traditional indemnity plans that reimburse the insured for the cost of health care received. Health and managed care plans offer health care through a network of health care providers and medical facilities. Both commercial insurers and managed care providers offer coverage to individuals and groups. Most people covered by health insurance are insured through a group plan. Group coverage is available for employer groups, franchises and associations, governmental units, municipalities, governmental insurance providers. For many people, government plans are the main source of their health care insurance. Medicare is a federal government program that provides hospital and medical insurance to people age 65 and older. Medicaid is a state public assistance program, with some federal support, that provides health care benefits for the poor of any age. The disability program under Social Security provides disability income to people under age 65 who become totally disabled. State workers' compensation provides benefits to workers who become sick or injured because of a job-related event. The federal government has created tax-favored health insurance arrangements, such as health savings accounts, medical savings accounts, health flexible spending arrangements, and health reimbursement arrangements, to encourage individuals and employers to save for their health care expenses. Group versus individual plans. Most people obtain health insurance protection through a group plan. A group plan is most commonly offered through employers or associations. An individual policy covers an individual policy owner or, at most, a family. Group insurance covers multiple people and their families under a single policy. A group insurance plan, like an individual plan, involves a single contract. The group plan sponsor, such as the employer, is the contract owner. Each participating member in the group, such as an employee, is issued a certificate of coverage that specifies the terms of coverage. Individual or family coverage. Health insurance policies can cover an individual or an entire family under a single plan. Those eligible for family coverage typically include the primary insured, spouse, and dependent children. New dependents can be added to the policy when they join the family through marriage, birth, or adoption. Regulatory impact on individual health insurance. The states have primary authority to regulate health insurance. State insurance regulators control how business is conducted and the insurance products that are sold within their state. Key point: be sure to study your state's rules and regulations in the state-specific chapters of this course because your license exam will test your knowledge of them. The Patient Protection and Affordable Care Act. While the states have primary authority to regulate health insurance, the federal government regulates certain aspects of it. This authority underlies the Patient Protection and Affordable Care Act, PPACA, also called the Affordable Care Act, ACA. The ACA is intended to reduce the number of uninsured Americans and the cost of medical care. Through mandates, subsidies, and tax credits to employers and individuals, the ACA requires all persons to participate in the program. The ACA also imposes tax penalties for noncompliance. A pool of insured persons becomes healthier when more members of the general population, not just the sick, enter the pool. This helps lower the cost of medical care for all members of the pool. So the ACA requires all persons to join the pool. Under the ACA, all health insurance policies are sold on a guaranteed issue basis, regardless of the applicant's health. Medical coverage is available to all persons regardless of pre-existing conditions. Dependent children, married or unmarried, are covered under a parent's group medical plan to age 26, although the spouse and child of an eligible dependent child do not have to be covered under the parent's plan. Low-income persons and families can take advantage of federal subsidies and Medicaid. Coverage must meet minimum standards. States set up health insurance exchanges to help individuals and small businesses shop for policies. The ACA applies to medical expense insurance. It does not apply to other forms of health insurance, such as disability income policies and long-term care insurance policies. Small employer eligibility. Some of the provisions of the ACA apply only to small employers, generally those with fewer than 50 full-time employees. Responsibilities and benefits for small employers include: medical insurance can be purchased through the Small Business Health Options Program, SHOP, which allows small employers to get lower costs on group plans and claim tax credits. Employers must withhold and report an additional 0.9% on employee wages or compensation that exceeds $200,000. Employers may be required to report the value of the health insurance coverage provided to each employee on his or her Form W-2. Employers that cover at least 50% of their full-time employees' premium costs and have fewer than 25 full-time equivalent employees may be eligible for the Small Business Healthcare Tax Credit. Benefits for dependent children. Though states differ in the ways they require health insurers to cover dependent children, some requirements are common to individual and group health plans in all states. Spouses and dependent children are eligible for coverage under group health plans. Newborn children are covered under a parent's group health plan from birth, although an additional premium may be required. Group health plans that cover dependent children must provide coverage up to the limiting age for as long as the child remains the insured's dependent and is enrolled full-time at a post-secondary school. Children under age 26 must be allowed coverage under a parent's group medical insurance plan. Dependent adopted children must be covered under the insured's group health plan to the same extent as children born to the insured. This coverage begins when the child is adopted or placed for adoption, whichever is earlier. Health Insurance Marketplace, Health Insurance Exchange, 42U. South Carolina, 18041, PPACSEC. 1321. A health insurance marketplace or health insurance exchange helps consumers shop for, compare, and buy health insurance from private insurance companies. The Affordable Care Act requires states to establish exchanges where the public can shop for and buy policies that meet the coverage requirements of the ACA and qualify for federal subsidies. Healthcare.gov is the health insurance exchange website of the ACA. There the public can shop for and compare health insurance policies offered in their state that comply with the Act. Persons may enroll in a qualified health plan through a health insurance marketplace during an open enrollment period, OEP, that runs every November 1st to December 15th. A person can enroll after the open enrollment period if a life event qualifies the person to enroll during a special enrollment period, SEP. Such life events include marriage, birth of a child, loss of other health insurance, moving to a new residence, becoming a U.S. citizen or having a lawful presence in the U.S., release from prison. Those already enrolled in a plan through the health insurance marketplace may qualify for a special enrollment period if changes to their income or household status affect their eligibility for premium tax credits or cost-sharing reductions. A person who voluntarily quits a plan between the annual enrollment period does not qualify for a special enrollment period. Private insurers in the marketplace must also offer plans that comply with the ACA. All plans must provide a statement of benefits, coverages, and a glossary of terms. However, a person may find it best to shop for a plan outside of the marketplace for these reasons. The person doesn't qualify for financial assistance through the marketplace. Such assistance is available only for plans bought through the marketplace. If the person doesn't qualify for this assistance, there is less incentive to buy a marketplace plan. The person wants to choose coverage from the greatest number of plans available. The marketplace doesn't offer all plans that are available from insurers. Navigators and other assistance for enrollment. Navigators, non-navigator assistants, exchange enrollment facilitators, and certified application counselors help consumers enroll in qualified health insurance plans sold through a state's health insurance marketplace. Some states require these persons to be trained and certified. Licensed health insurance producers can also help consumers enroll in these plans. Cost-sharing subsidies. Low and moderate income families may qualify for federal tax credits that help them pay for health insurance. These subsidies make health insurance affordable for families who can't participate in an employer's group health plan. The subsidies reduce the cost of the premiums and the out-of-pocket expenses for coverage that the families buy through the marketplace. The amount of the subsidy is based on the size of the family and its annual income. Essential health benefits, 42U. South Carolina, 18022, PPAC Sec. 1302. All ACA-compliant health plans must provide these essential health benefits, EHBs. Ambulatory patient services. Emergency services. Hospitalization. Maternity and newborn care. Mental health and substance abuse disorder services. Prescription drugs. Rehabilitation services and devices. Laboratory services. Preventive and wellness services. Chronic disease management. Pediatric services. Annual and lifetime limits. The ACA restricts a group plan's ability to curtail benefits. No lifetime limits on essential health benefits, EHBs. No annual limits on EHBs. The prohibition on lifetime limits on EHBs applies to all health plans. The prohibition on annual limits on EHBs applies to most health plans, but not to grandfathered individual health plans. See the discussion of plans with grandfather status in this lesson. Insurers can still set annual and lifetime limits on benefits for healthcare services that are not EHBs. Metal levels. Insurers must offer benchmark plans that provide coverage at one of 4 metal levels: bronze, silver, gold, and platinum. Each level corresponds to the percentage of EHB costs that the plan pays, with the insured paying the remaining costs. Please pause the audio and review the table. Catastrophic plans. Catastrophic plans are available to persons who are younger than 30 years and cannot afford any other health insurance, or who want minimal coverage in exchange for a high deductible and a low premium. These persons are usually single, low-income individuals whose employers do not offer group health insurance. Catastrophic plans provide the same essential health benefits as the other metal plans. They also cover 3 annual visits with a primary care provider and preventive care, which are subject to the annual deductible. The deductible is the same as that for the bronze plan, but the bronze plan does not limit visits with a primary care provider to 3 per year. Preventive care. Medical plans must cover preventive care services. The insured does not pay a copayment or coinsurance, even if the annual deductible has not been met. These are some of the preventive care services that ACA-compliant health plans must provide at no cost. blood pressure screening, colorectal screening, depression screening, diabetes, type 2, screening, immunization vaccines, tuberculosis screening, pre-existing conditions. Health insurance plans issued since January 1, 2014, must cover pre-existing conditions for any adult applicant or dependent. In other words, a health insurance company cannot refuse to insure an applicant or refuse to renew a policy due to a pre-existing condition. Furthermore, a plan cannot charge more to cover a pre-existing condition. Health insurance plans that have grandfather status, those that existed on or before March 23, 2010, are exempt from this requirement, subject to certain conditions. Key point: the prohibition on exclusions for pre-existing conditions applies to individual and group medical expense insurance plans. It does not apply to other types of health insurance policies, such as accident or disability income policies, long-term care policies, or standalone dental and vision policies. Grandfathered versus non-grandfathered plans. Group and individual medical plans that existed on March 23, 2010, are grandfathered and are exempt from some of the ACA's consumer protections. To keep this status, they cannot reduce benefits or increase costs for insureds. Plans issued after March 23, 2010, must comply with the ACA. While many of the ACA's protections apply to all plans, grandfathered plans are exempt from some requirements. Grandfathered group medical plans do not need to cover many of the preventive services required of non-grandfathered plans. They can charge the insured for many of these services. Grandfathered individual medical plans can continue to impose annual limits on benefits. Grandfathered individual medical plans are exempt from the prohibition on annual benefit limits and may continue to exclude pre-existing conditions from coverage. However, these conditions cannot be excluded for more than 12 months. Grandfathered group plans and self-insured plans cannot exclude these conditions for more than 18 months for late enrollees. In addition, annual limits cannot be unreasonably low. Rescissions. The Health Insurance Portability and Accountability Act, HIPAA, requires insurers to renew an insured's health coverage under most circumstances. The insurer must first notify the insured about the pending cancellation. An insurer can cancel coverage if the insured committed fraud or failed to pay the premium. The insured can also cancel coverage if it no longer offers the type of plan covering the insured, if the insurer leaves the area in which the insured lives, or if the insurer no longer belongs to the covered group. Payments and billing. To make it easier for insureds to pay for medical insurance, qualified health plans must let insureds pay what they owe through deductibles and copayments. Medical loss ratio. Insurers must spend a minimum percentage of premium dollars on providing healthcare coverage and improving the quality of healthcare. The medical loss ratio, MLR, is a standard that insurers follow to ensure that they spend premiums primarily on healthcare coverage, and not on business expenses. For individual plans, insurers must spend at least 80% of each premium dollar on healthcare services and on improving the quality of those services. For group plans, insurers must spend at least 85% of each premium dollar on these. An insurer that fails to meet these threshold minimums in a calendar year for all the plans it issues must refund the excess premiums to insureds. Internal reviews and external appeals. The ACA requires insurers to have a procedure to review consumer complaints. Insureds can appeal denials of coverage through their plan administrator. Subsidies and tax credits, 42U. South Carolina, 18070, 18071, PPACSX. 1401, 1402. The ACA compels every person to get coverage through a qualified health plan, either by owning an individual policy or participating in a group plan. To help people comply, it lowers premiums or gives subsidies to people with low to moderate income. Individuals and families may qualify for a tax credit to reduce the cost of premiums. States can also make it easier for people to get qualified health plan coverage through Medicaid. Penalties and fines, 42U. South Carolina, 18071, PPACSX. 1501, 1502. The ACA requires everyone to get coverage through a qualified health plan. When first enacted, it enforced this requirement by penalizing individuals and employers who did not comply, though this is no longer the case with respect to the individual mandate. Individual coverage mandate. All individuals are obligated to obtain health insurance coverage. Initially, this mandate was enforced with a penalty that started at $695 per year, $347.50 per child under 18 years, or 2.5% of income, whichever was higher. Due to a 2017 U.S. Supreme Court ruling, however, this penalty was deemed unconstitutional and was eliminated on January 1, 2019. While several states have imposed a penalty for being uninsured, there is no federal penalty for individuals who do not obtain health insurance coverage. Employer coverage mandate. The law does not require employers to provide their employees with a qualified health plan. However, employers with 50 or more employees that do not offer a medical plan face a penalty if any employee receives a government subsidy to buy individual coverage. The penalty amount is up to $2,000 annually for each full-time employee. Employers who do offer coverage, but whose employees receive tax credits anyway, are subject to a fine of $3,000 for each worker receiving a tax credit. These penalties are adjusted annually for inflation. Employers are to consider wages paid, employees' hourly rates, or the federal poverty level to determine whether the coverage they offer to their employees is affordable under the ACA. To avoid the penalty for failing to offer affordable health coverage to its employees, an employer is required to offer coverage to 95% of its full-time employees. Requirements for individual and group plans vary even if they cover the same risk. States mainly control the provisions of individual health plans. Insurers are freer to impose restrictions and exclusions on individual policies than they are with group policies. But the federal government has imposed requirements on group plans to protect workers and their dependents. Health Insurance Policy Owners' Rights, PPACSX. 1511 to 1515. Policy owners have rights concerning disclosure of their policy information from the insurance company, access to routine and emergency health care, and complaint resolution. Regarding policy information, policy owners have a right to a description of benefits, benefit limits, exclusions, and necessity of medical care. How they get pre-authorization or prior approval, if required, of healthcare services. The utilization review procedure and how it is used to determine necessity of medical care. Their responsibility for premiums, deductibles, co-insurance, co-payments, and annual limits. The insurer's grievance procedure. When getting health care, policy owners have a right to information that explains how to get emergency medical services, how to get care from primary and specialty care providers, how to get care outside the health plan's provider network, how to get a referral to a provider outside the network, any requirements that must be fulfilled for medical treatment or services. Claims. When claiming benefits under a disability income policy, the insured will likely have to submit ongoing proof that he or she remains disabled to keep getting benefit payments. Medical expense plans may require that the cost incurred be for medically necessary care, care that is needed to diagnose, treat, or prevent illness or injury and meets accepted standards of medical practice. The insured may be required to get the care from a particular caregiver to receive the benefit payment. Some medical plans require pre-authorization from the insurer before the insurer will cover the costs of a medical procedure. Basis for claims, reimbursement versus valued. Health insurance may be written on either a reimbursement basis or a valued basis. Reimbursement contracts base the amount of benefit on the loss. For instance, a policy that pays 80% of the covered loss is a reimbursement contract. Medical expense policies are reimbursement contracts. Valued contracts pay a stipulated sum, without regard for actual expenses. Accidental death and dismemberment insurance policies are valued contracts, as are life insurance policies. Dread disease policies that pay a stated value upon loss are valued contracts. For your review. Health insurance protects against illness and accidental injury. Different health insurance policies protect against different risks. Disability income, Replaces income if disability prevents insured from working. Medical expense, covers cost of medical care and medical services. Accidental death and dismemberment, AD&D, pays lump sum benefits if accidental death or injury results in dismemberment. Medicare supplement, private insurance that supplements Medicare. Long-term care, covers the cost of long-term care, nursing home, home health care. Limited benefits, covers dental, vision, prescription drug, or specified, dread, disease. Health insurance is provided by commercial insurers, health and managed care companies, the state, Medicaid, and the federal government, Medicare. Traditional indemnity plans reimburse the insured for all or a portion of the cost of health care received. Health service providers and managed care providers deliver health care to their insureds through a network of health care providers who are employed by or under contract with the providers. Highlights of the ACA include guaranteed issue of medical insurance coverage without regard for pre-existing conditions. Dependent children covered under parents' group medical plan to age 26. Federal subsidies and Medicaid for low-income individuals and families. Minimum standards for health insurance policies. Exchanges in every state where individuals and small businesses can buy health insurance. No lifetime limits or annual limits on essential health benefits. 4 metal levels, bronze, silver, gold, and platinum, with escalating coverages and benefits. Medical plans that existed on March 23, 2010, are grandfathered, exempt from some ACA consumer protections. They can also impose annual benefit limits and exclude coverage for pre-existing conditions. Reimbursement contracts base benefit on the loss incurred. Valued contracts pay a stipulated sum without regard for actual expenses. Please pause the audio and watch the video.
Health insurance, they're usually referring to medical expense insurance. As this lesson explains, the term health insurance actually covers a wide array of products. Now, to help understand the significance of that, compare health insurance to life insurance. With life insurance, although there are a variety of different types of products, they all cover one peril, and that is the peril of death. Different approaches to the product, one single peril, death. With health insurance, you actually have not only a variety of different types of products, but a variety of perils covered by individual products. For example, in addition to medical expense insurance, which covers against a peril of illness or accidents and the costs associated with getting treatment for those, there is disability income insurance, which covers against the peril of a disabling accident or illness and the attendant loss of income that can come from that. There is long-term care insurance, which covers against the peril of needing long-term medical care, long-term nursing care. There is dental insurance, and there's a unique type of insurance called accidental death and dismemberment, or AD&D insurance, which, as we'll see in a little bit, it looks like a type of life insurance, but is a type of health insurance. So, as you're studying the health insurance course, keep in mind that that term health insurance is an umbrella term that covers a lot of different types of products covering a wide variety of perils, as opposed to life insurance that covers one peril.
All right, so I think this is the longest video that we've had in this series. And let's get right to it because this is a pretty long video. All right, what level of government mainly regulates health insurance? Federal, I do believe. How does health insurance differ from life insurance? Against risk more than once in a lifetime. Which statement about health insurance is correct? The federal government controls provisions. Most people buy health insurance in an individual policy. A group plan is offered through employers. An insured health policy plays a... Let me speak. An insured health insurance policy pays a flat rate of $200 a month if she becomes disabled, regardless of income. What policy does she have? Oh boy, medical expense. Excuse me. Getting all choked up over this question. If you made it this far, congratulations, because that is amazing. 30 minutes of this, I was like ready to go to sleep. Okay. So it's mandated at the state level. Okay. So that's interesting. I didn't know that. I thought it was federal. The state level regulates the health insurance. Unlike the risk of death, a person may face health risks many times during their life. All right. A group plan. A group plan is usually offered through employers or associations. Okay. The state mainly controls the provisions of individual health policies. All right, and so the last one here, this person has a valued policy. Medical expenses policies cover the cost of medical care, medical services. Medical expense policies are reimbursement policies. All right, so we're going to end this video because it's already long enough. See you on the next one.